Is Michael Saylor right that Bitcoin and other crypto assets may end up being more valuable than SPY? Indeed, we do. Yes, we certainly do. Of all the crypto asset ecosystem, Bitcoin will be the most important component. It will be worth $20 trillion by 2030, according to our projections. With $20 trillion on the table, how much will exchange-traded funds receive? Regardless of their packaging, I estimate that all public equities worldwide are currently worth over $120 trillion. I don't know, but that sum alone is staggering when you consider it in context. My prediction of $20 trillion by 2030 is thus a massive category. Not long ago, Cathie divulged her perspective on Bitcoin, highlighting its capacity to surpass the value of conventional assets. To her, Bitcoin and other cryptocurrencies have the potential to become more important than the SP 500 index. Also by 2030, Cathie thinks Bitcoin alone may be worth an astounding $1 trillion. This viewpoint emphasizes the growing interest in and enthusiasm for digital currencies, as well as the possibilities of Bitcoin. In light of these forecasts, how should investors in the world economy react? The ramifications of Cathie's predictions warrant investigation. First, it implies that digital assets will play a more significant role in the future of investing. To consider cryptocurrency a real asset class, investors may have to reevaluate their current holdings. Second, exchange-traded funds ETFs play an increasingly important role in the adoption of cryptocurrencies. Cryptocurrencies may see a surge in acceptance due to ETFs, which offer a regulated and easily accessible mechanism for investors to get exposure to the market. Also, big things are coming for Bitcoin according to Cathie's forecasts. If the cryptocurrency can reach $1 trillion in price by 2030, it would have accomplished something truly extraordinary and established itself as a powerful force in the global financial landscape. Institutional investors who have been wary of cryptocurrency investments up until now may change their minds after this landmark. Finally, Cathie's optimistic Bitcoin outlook reflects a new paradigm in the investment world, where digital assets are rising to the forefront. The projected Bitcoin milestones and the role of exchange-traded funds ETFs in crypto adoption highlight the dynamic character of financial markets and the possibility of cryptocurrency to transform the world economy. Every exchange-traded fund ETF available today own around 3.9 or around 4% of all Bitcoins in circulation today. The intriguing part is that long-term holders make up about 15 million of the Bitcoins in circulation, or about 15 million. Our analyst David Well does on-chain analytics for us so you can see this. Current outstanding balance is 19.5 million, with a total of 21 million due at some point in the future. There will be no sales by those long-term investors. That is the current state of the price. We estimate that the additional $1.5 million in Bitcoin will need to accommodate a large number of investors, institutions, and the like, given the flows into exchange-traded funds ETFs, which have simplified the process of purchasing Bitcoin and can serve as collateral for loans, in contrast to Bitcoin itself. To rephrase, in order to remove part of the supply from the hands of long-term holders, the price will need to rise sufficiently. To be clear, long-term holders have kept their Bitcoin in their wallets for at least 155 days. You can track this on-chain. And when that happens, the likelihood of their selling their Bitcoin drops significantly unless there is a huge price surge. With the anticipated halving event this year added to the current demand dynamics, we have the following picture. Given the picture you just described, how do you think this year's halving will affect prices differently? Indeed, the halving. As a result, the annual growth rate of the Bitcoin supply will drop from 1.9% to 0.9%. Thus, we will achieve a first-ever drop below 1%. And if you look at the extremely long-term history of gold, you'll see that the average expansion in supply has been about 1%. Thus, the rate of increase in the Bitcoin supply is now slower than that of gold. I would call that a landmark. Additionally, in this case, a mining response typically occurs when the price of gold jumps, leading to an increase in supply. Bitcoin prevents such from happening. This is a completely new dynamic, therefore that turning point is the halving. In addition, the price of Bitcoin has typically done exceptionally well after halvings, according to historical data. Currently, it takes some time. It takes longer than expected. The reason why eludes me. Just consider how many people are aware of the halving this time around 4 years ago. Most of them had no idea what Bitcoin was. This might change now that the market is more efficient with ETFs. What it actually was remained a mystery to them. If I may add one more, it has to do with our attempts to define this monetary revolution. Plus, you can't ignore any of these words. the world's first ever digital, decentralized, rules-based monetary system that is critical, private, and operates independently of governments. Art Laffer, who is well known for his work on fiscal policy and the Laffer curve, was my mentor in this area. He also has a background in economics. I have been waiting for this for 50 years, he exclaimed, referring to the period beginning in 1971, when the United States gold window was closed. In March of last year, something significant occurred in the United States: a regional banking crisis, the collapse of many regional banks, and the meteoric rise of Bitcoin. From 19,000 to over 40,000, it increased significantly. What was the point of that? Bitcoin, much like banks, does have counterparty risk, as it's shown. So it turned into an asset that could withstand risk. Prior to this, we had only considered it an asset risk. Bitcoin is poised to be a prime beneficiary when liquidity flows. From an asset allocation standpoint, institutions have a fiduciary responsibility to consider it, despite the fact that it is also a risk asset. Our white paper aims to demonstrate that its correlation with other assets is so low. Well, if they wish to ignore it, that's okay with Vanguard. We believe Vanguard is either doing nothing or is continuing its policy of never investing in commodities. Therefore, it is merely viewing this as a commodity. It hasn't, generally speaking. We believe this is a new asset class, and they will be cutting Vanguard clients out of it. If return correlation remains low, investors in this asset class will outperform Vanguard advisors because their returns per unit of risk will be higher. Consequently, I anticipate a demand draw even inside the Vanguard ecosystem. Put Vanguard out of our minds for a second. The price we're looking at appears to be driven by numerous different demand factors, as you pointed out. Has your predicted time to reach that price now shrunk, assuming you had that bull case for over $1 million USD in Bitcoin? That was our original goal before the SEC gave us the go-ahead. In my opinion, there was a watershed moment that accelerated everything. I will state categorically that no wirehouse, not even Morgan Stanley, Merrill Lynch, UBS, or Wells Fargo, has approved Bitcoin as of yet. Everything that has transpired in the pricing has occurred prior to their approval. Our journey has only just started. Our assumed incremental cost for institutions has really increased by almost 100%. I don't want to give out specific rates just yet because we don't know how fast some platforms, those that work with independent registered investment advisors in the US, are claiming to do their due diligence. Everyone else is stating that we require a minimum of 6 months. This is why I would also classify those as belonging to the institutional category.